As you've often heard me say, property investment may be simple, but it's not easy. It's simple if you follow the rules and the right strategy, but it's not easy because there are so many moving parts, and most people don't even recognise that. Successful property investment requires the collaboration of a team with expertise in property, in finance, in tax, the law, and financial planning. If you're a regular listener to this podcast, you know I try and have a mix of all of those things to give you a holistic overview of both the science and the art of property investment. And today's show's no different because I'm going to have a chat with Ken Race, my business partner in Metropole Wealth Advisory, about the best ownership structures for property investment that's going to enable you to not only grow your wealth, but protect it and pass it on to future generations. Now, while Ken's an accountant and he's got a detailed knowledge of the taxation aspects of real estate and business, he's also a great person to have on your team because he's a licensed real estate agent, a financial planner, and he's been the managing partner of a national firm of accountants. And prior to that, he worked in a large international company as an accountant. Now, Ken doesn't do normal accounting. He doesn't do beekeeping, but he advises Metropole's high net worth clients. He advises business owners, and that's why I know you're going to get some gems from my chat with Ken today. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
What's the best structure to buy your property in? Now, property investors usually ask us this question because they feel having the right structure is going to help protect their assets, or maybe it's going to save them tax. But there are many more considerations than that, and that's what we're going to chat with in today's podcast with Australia's leading tax strategist, Ken Race, Director of Metropole Wealth Advisory. Welcome, Ken.
Hi, Michael.
Now, Ken, I know that when it comes to structuring, whether it's for property investors, property development, business, other activities, obviously one size doesn't fit all. And that's because people's individual circumstances are different. So we need to take those into account when coming up with the right structure to fit their specific needs. So I guess being an accountant, we better be careful and give the initial disclaimer right now saying that we're not giving tax advice, we're not giving structuring advice, but in this chat we're going to have today in this episode of the Michael Yardney podcast, we're going to give as much information as we can, but at the end of it, we're going to explain how people can find out more. Ken, today I'd like to just cover a couple of topics that clients regularly ask us at Metropole about the benefits of the right ownership structures. What are the different sort of ownership structures? What should they consider? How to take them to their advantage? And I guess what I'd like to get from you with your years of experience is what traps they should avoid. So this is for property investors, business owners, professionals. Ken, let's start with the obvious question. What are structures? What are we talking about?
Structures are a way of controlling your assets and not owning them. So you get all the benefits of having the assets, the wealth, and then creating estates to pass on to your children without actually owning them. So they give you a better way to manage the cash flows, the tax, the asset protection, and the actual management of the assets. So it separates you from the asset, but you still get all the benefits that you would have normally had.
Okay. Now, I think some people listening to this podcast are saying, tell me about the sexy stuff, the exciting stuff. I want the excitement. Let me explain. This is the excitement, but it actually prevents other sorts of excitement because you don't want the bad news when people come up to you and sue you or take advantage of you, or your kids separate or divorce and you lose part of your assets that way. So please stick with us because this is what you've got to do. And even if you're a beginner, this is really relevant to you. And if you're thinking, hey, I've already got my portfolio, I'm not going to do anything, that's a big mistake. There's still lots that people can do or should consider, isn't there, Ken?
There certainly are, and people's circumstances in life change. So, what might have been appropriate when you first came out of uni, your first job, your first managerial position, then changes over time. And therefore, you might now need to relook at the structuring and your asset protection when the time is now maybe a little bit more appropriate to do so.
So what we're really saying is structures are all about what name you will purchase properties in, whether your investments, your business, or other valuable assets, including your home. So this is still relevant for people who are wondering, what should I do with my home? But the other thing is it's going to have long-term consequences. So let's start with what are the different type of structures that we could be considering, Ken?
Look, in the main, there are companies and trusts, and companies have been around literally for over 1,000 years, and trusts have been around for literally nearly 800 years. So they're not a new concept. So they've been around, people have been using them, the system, if I can call it that, understands them. And the big difference is, I think, they're now coming into the purview for ordinary people, not just the mega rich, not just the people with huge businesses. So can I say ordinary Australians should be taking advantage of what has traditionally been only available to the super rich and the people who have access to the large end of town in relation to lawyers and accountants and tax experts.
Well, that's actually a good point, because while there is a little expense at the beginning setting it up, the savings are definitely worth it. So let's talk a little bit about these things. You talked about companies. People don't always understand trusts and their uses. Maybe you could explain a bit about that to us.
Yep. So companies are very regulated. So by ASIC in Australia, the Australian Securities Investment Commission, they stipulate the minimum requirements of a company. It's called its constitution, the rules by which the company operates. So even if you have a constitution that excludes certain things, the legislation brings it into account. So you still have to live within the rules of the federal government. And companies are regulated at the federal level. Trusts, on the other hand, there is no law, there is no rules of what has to be in a trust. It's just a set of rules that is managed under state legislation now. And therefore, the benefit of a trust, or the trusts that maybe operate better for your circumstances versus another, are in the hands of the person you buy it, because they take the rules. So they must understand what you're trying to achieve and therefore put you into the appropriate trust. It's the same as saying, I love driving on a Sunday afternoon with the top down, the air in my hair, and the salesman tries to sell you a truck. Okay, it'll get you from A to B, but it won't do what you want. It's the same as for trusts.
So really a trust's a document. It's got clauses in it. It's got sentences and words, and you should actually say in that trust what you want to achieve. Now, and the way I remember in the old days I used to explain it to people was, if I have my sister who's got some kids, and I said, I actually want to give you some money. Please take this, and I want you to go to, when you go on holidays to Queensland, I want you to hold this on trust for the kids, and I actually want you not to spend it on lollies and on fairy floss, but I want you to take them to Dreamworld or SeaWorld, and I want you to actually buy them rides and do this and that. I can give the person who controls the trust, who's a trustee, access to these funds to do specific things with on behalf of other people. And in this case, what we're saying is this could well be in the future for my kids or grandkids, but maybe in the short term for me.
Correct. So trusts have the control of the rules through the trustee, and they might own the asset. They might, like your sister, have the cash in their hands, but they've got a legal obligation to use it the way you've stipulated or the way the trust has stipulated. So that's when we get into the two main categories of trusts. Trust number one is a discretionary trust, which gives a wide berth to the trustee to distribute the money as they see fit, again within rules, or fixed trusts that give fixed entitlements to certain people, and the trustee can't change that. And discretionary trusts, because they've got such flexibility in what you can do with the money, who you can give it to, they've been nicknamed a family trust, because you normally wouldn't go into business with somebody where they didn't have to actually give you a distribution.
So I know personally I own all my assets in structures, not in my own name, and I have a mixture of discretionary trusts and fixed trusts, companies, and in fact, my superannuation fund's a trust too, isn't it?
It certainly is. And it's more of a fixed trust because you as Michael have to have the access to your members' balance, your funds. It can't go to another member. So, and on your death, your members' funds would then be dictated through either your will or through a direct instruction to the trustee of the super fund of who to give that money to.
Now, I guess some people are listening to this and getting a little bit bamboozled. We're trying to make it simple, but we've written a book that's been very successful over the years, what every property investor needs to know about finance, tax, and the law. So I'm going to put a link to it in the show notes because there it's actually outlined with diagrams and you've given some very, very detailed explanation of this. Of course, it doesn't substitute for getting specific advice, but if people are wanting to have a better understanding of it, what every property investor needs to know about finance, tax and the law. But maybe you can short circuit things, Ken, and tell us what are some of the benefits of using a trust?
Yep. So people who use trusts do it for a number of reasons. And the main ones are they want a more efficient way to distribute the cash flows. They want to be able to manage their tax affairs. They want better control and management of their estate on death. The estate are the things you own. They want more flexibility in how to distribute, how to grow their wealth. That's very important for a lot of people. Asset protection is a key area as well, because the trust owns the assets, not you as the controller. So if you're individually sued, they can't get to your assets in the trust. So asset protection is a big one. And one of the other reasons that people use trusts is a way to get all the above, but either through fixed entitlements, business owners, if I'm in business with you, Michael, as I am, and we want to know that we're each entitled to a certain percentage, then we would use a fixed trust for that distribution. Or for my family, we have the discretionary trust, where it's decided at the end of each year who will get what based on different parameters, such as your tax rate, are you being sued at the moment? Are you wanting to invest in other areas? So trusts are not normally taxed, and that's their advantage. So the trust itself is not taxed. It gathers the money like a bucket, and then when it distributes it, the people who receive the money then get taxed at their rate. So trusts are very good to manage the tax affairs of different people with completely different tax obligations. Instead of saying, I'm going to tax everybody at 30%, the large corporate tax rate, and then individually you'll either get some back or pay more. So they're very good for tax management.
One of the things I've recognised is that, as we said right at the beginning, we've all got different needs, and you can get a trust online. There are lots of companies that are going to just allow you to put your details in online, and most accountants, well, I guess all accountants understand about trusts, but if you really want the sort of trust where you can get the most benefit from it, you need to work with somebody who understands state taxes, federal taxes, capital gains tax, GST, state tax laws, stamp duty, land tax, payroll tax, and foreign taxes. Ken, I know that there are some little traps with trusts at the moment because many of us were born overseas or have families overseas. And there's some, I think, probably unintended consequences where people who've got what they think is a safe little family trust for them and their kids who live in suburban Australia, but they get caught out because there's somebody in their family who happens to live overseas, even if it's only in the short term.
Correct. So I was going to say funny stories, not funny for the client, of course, but I only had an email literally today from a client saying their accountant advised them of this foreigners tax and they better have their trust looked at. And she wrote to me saying, what do we need to do? And I reminded her of the fact that 3 years ago when she first came to see me, I identified that as a problem and we actually fixed it 3 years ago. And that was because it was an understanding of the asset protection, the tax, the federal level and the state level. So we need to bring all those things into account, including the law. I had another client who came to me. It was too late. They came to me after they'd had an audit, so they weren't a client of us before that time. His son went to live in the US, married a local girl, and that trust was now classified as a foreign tax. And unfortunately, they'd bought a property after that relationship, so they were back charged with double the stamp duty of what would have normally been paid. And the land tax is also double what it would normally have been. So unintended consequences for sure. So get those trusts checked. They can be fixed moving forward, unfortunately not retrospectively.
So because so many different rules, laws, jurisdictions can potentially affect the trust. And remember, this is something that you're going to be using, I guess, forever. So you've got to plan for the future as well. So even if you're not thinking at the moment about passing on assets to children or grandchildren, you may not even have them. What you've got to do is plan for the future, plan to become the person you plan to become. So there's got to be some strategy around it. And I know, Ken, that's where your team does something a little bit different to others. So accountants tend to look after compliance and solicitors tend to look after protecting your interests and maybe estate planning, and financial planners tend to look a bit about how the money all works. A lot of clients seem to have trouble joining all the dots when they want to set up these structures, Ken.
That's right. And I think the problem is they don't start off with the end in mind. You've got to start off, as you said, with a strategy. You've then got to understand the resources that's going to be put in the trust. What sort of assets, the dollar value, which state. You've then got to understand the accounting and the tax implications of that, and then set up the trust that is most appropriate for those needs while keeping in mind future flexibility. And that also includes what happens on your death. How do you pass over control of that trust? Particularly if it goes to children who unfortunately might have a marital breakdown. We don't want everything to go to the in-laws, so to speak. So
outlaws, so to speak.
Yeah.
Having been there, I understand, Ken.
So we try to keep it lighthearted. So we've got to start off with the strategy. We've got to then move to the correct trust. We've then got to set it up correctly. And then we have to manage it ongoing correctly. And a failure in any of those areas can actually either void the trust in a worst case scenario or limit or reduce any of the benefits that you've been trying to achieve.
Now, before people panic too much, there are things that can be done to amend trust deeds. Now, you can't do everything that you like because that could actually end up costing you capital gains tax and other costs as well. But before you get too concerned, hey, I didn't understand all these things, one of the things I know you and your team do at Metropole Wealth Advisory, Ken, is actually do an audit and an assessment to see, is it okay? Is there something that you can do to bring it up to date? And I know over the years, because my first trust I put together probably 45 years ago, boy, My life has changed a lot since then, so things have had to be updated and changed.
Absolutely, absolutely. So this is one of the areas where the tax office has actually become a lot more amicable to not hitting you with taxes at every opportunity. So there are a number of things you can do to change your trusts to make them more appropriate, and other things, unfortunately, you can't. And it might be at that stage that you say, well, I won't keep using that particular trust to grow my wealth. I'll set up another one. So that'll be a discussion that you'll have, and then we'll be able to decide whether we fix it and you keep moving with the same vehicle, the same trust, or whether you then set up a new trust for ongoing investments.
So what are some of the common mistakes people make when using trusts, Ken?
Look, maybe I'll just expand that a little bit more and say structures and predominantly trusts. So
That's okay. You're allowed to answer any questions you like, Ken.
The most common mistake I see is people setting up a company, particularly to operate a business, and they become the individual shareholders. That almost destroys all the benefits you've tried to achieve. So we need to look at that. They use a company in a lot of instances when a trust would have been more appropriate. I know when I studied at uni quite some time ago now, we spent a bit of time learning on companies, but virtually nothing on trusts. So it's not your accountant's fault if they don't understand all these things. They're the GP. You'd sometimes have to go to a specialist and then go back to the GP for the ongoing thing. So
now, interesting you say that, because I know there are also occasions when it's the other way around, and there are certain circumstances where you've actually suggested a company is the most appropriate structure, even to own properties, even though it doesn't get capital gains tax exemption. And people sometimes find that counterintuitive. It's not what their accountant told them, Ken.
That's right. And for people listening to this, you would have heard me say, never, ever, ever, ever buy property in a company. And that's because it's too hard to say, except if you're one of the 1,000. But there is a small group of people where a company is very appropriate. And if correctly set up, you can actually increase the available cash you have to invest by almost double. So instead of paying the tax man a certain tax bill, you reduce that tax and use that money as a deposit. So there are a few people, particularly those in larger businesses, where if the business is set up correctly, they can take advantage of that. That's a question that you can ask if you come and see us, and then we'll be able to go through whether it's appropriate or not for you.
Okay, back to my original question, Ken. I did my normal job of interrupting you. I was asking you about the common mistakes people make when using structures. I paid attention. I didn't say trusts.
Yeah. So one of the other very common mistakes I see is people are put into the wrong type of trust. So I get a lot of clients who come to see me. They've gone to see their lawyer. They've moved into their own business from a PAYG position. So they go to their lawyer and say, I've got to have asset protection. Give me a trust so I can buy my assets. And 2 years later, when they're getting their tax returns done, their accountant says, but you can't get a tax deduction for the interest that you've got on the loans for those investments. Now, if that's someone that's listening to us, that again is correctable. We can amend the deed and do a few other things to actually give you back that tax benefit. A lot of people aren't looking correctly at this foreigner's tax. And that is a very insidious tax, because you don't know that you're going to be caught, because sometimes you don't know who your relatives are. It seems funny, but you might know your brother, but you don't know that your brother is now going out and in a de facto relationship with non-Australian citizen. So you would be caught.
Now, let me explain to people who are listening to this that many trusts have very broad definitions of who beneficiaries can be. And even if you've never given them any money, distributed anything to them, if they are foreign residents, and we almost all have somebody who has a relative overseas, came from overseas, moved overseas, you could get caught out and end up, as Ken's already given an example of, having to pay more than you expect to. So if you have any doubt at all, my suggestion is go to metropole.com.au, find out about Ken's Wealth Advisory services and make a time just even to have an initial chat. We won't charge you for that, Ken, will you? But to actually see, can I help you?
That's right. Yep. So we can look at that.
Sorry to interrupt, but I just thought people are thinking, oh, it's not good. What do I do? How do I even know if I need this? Well, the answer is you probably won't, but that's not necessary. You don't need to if you've got somebody like Ken on your side. So back to the incorrect use of trusts, Ken.
Another very common mistake I see is if someone owns a property in a trust and they sell that trust, a lot of trusts will add back the depreciation twice, because when you sell a property, you've got to add back the depreciation on the building. Some trusts trigger that being added back twice. And therefore that increases the capital gain. Again, avoidable if the management and the ongoing administration was done correctly.
Now, interestingly, a lot of people don't realise that. In other words, they buy a new property or they have one where there's depreciation and they think, this is fantastic. I'm actually saving tax, and you are. But when you sell the property, if over the last years you've actually claimed, let me make up a figure, $70,000 in depreciation over the years, that actually has to be added back to work out your capital gains tax, doesn't it, Ken?
Correct. And in some trusts, if the sale entries aren't done correctly, you've got to add it back twice. So that means you add back $140,000. So the tax on that could be quite significant. I had a client who's got a very large share portfolio, and the way they were going to distribute that wealth on their death meant that that would have been automatically taxed on their death. Normally, when you die, when assets go to your children, there's no tax. But shares are looked at differently. And in a lot of circumstances, then that can be taxed on the date of death, not on a sale. So again, you've got to have a look at what assets you're distributing. So as part of your estate planning needs, you should be distributing different assets to different people, because there are completely different tax outcomes depending on what asset is distributed and to who that asset is distributed. And again, totally avoidable. And maybe to start wrapping it up a bit, you mentioned the distribution, that people go into these things forever. And you mentioned you had set up a trust 45 years ago. Trusts have an end date, 80 years. And that came about a couple of hundred years ago when they wanted to introduce death duties. And they said trusts should not last forever. They've got to have an end date, and then that way the government can get some taxes. But there are ways to set up your trusts so they can go forever. And Michael, you will live another, 35 years. So that trust of 45 years would be triggered in your lifetime. Or imagine your children or your children's children. So 80 years sounds like a long time. And yes, you might be dead and it'll be your kids' problem. But you worked very hard to build up that wealth. Why create an avoidable tax which could have been, as I said, avoided?
Well, there's a whole lot of other errors that people have in setting up their structures, running their structures, managing their structures, reviewing their structures. But I guess the intention of our chat today was to make people aware of some of these, because there's stuff you know you didn't know, but there's a whole lot of stuff you didn't even know you didn't know. And that's why I suggest that you have a chat with Ken to see, are you using the right structures, or what can you do? Now, if you're about to get into property investment or business, right time to start. If you're already there, it doesn't matter anyway. One of the things I've learned over time is it's best to avoid unnecessary risks, liabilities, and it's also important to get the right people around you. So again, as I said at the beginning, while a lot of accountants understand this, lawyers understand this, sometimes they don't understand the other implications involved. And that's the benefit of having somebody like Ken on your side as the go-between between the accountants, the solicitors, the financial people, the property people. So if you go to metropole.com.au and have a look at our wealth advisory service section there, or just leave your details anyway and ask to have a chat with Ken, you can find out, should you be considering using structures to protect yourself, to look after your assets, to pass on your assets in the future. And we'd love to give you that advice and be part of your wealth creation journey. So Ken, thank you very much for your time, and I look forward to our next chat real soon.
Thank you, Michael. And maybe just to finish off, I'll just make listeners aware. There's a lot of fallacies out there. There's a lot of unknowns. So ask. That's what I learned a long time ago. The power is not in knowing the answer to something, but being able to ask the question. And as an example, I had a couple of doctors come to see me a month or so ago. They wanted to buy their trophy home, but they were scared about asset protection. So they were going to put it in a trust and lose the main residence tax exemption. And I asked them, why are you going to lose the main residence exemption? They said, my accountant told me I would. Well, we've got a home trust structure that actually allows you to buy the home in a trust and still get that main residence tax exemption. So I use that as an example to have an inquiring mind, seek the advice, and go to people who are specialists in the area.
Great advice, Ken. Thanks a lot. Catch up with you again real soon.
Thank you, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to share the concept that successful people start before they feel ready. Now, let me tell you a story. In 1966, a dyslexic 16-year-old boy dropped out of school. With the help of a friend, he started a magazine for students and made money by selling ads to the local businesses. With only a little money to get started, he ran the operation out of the crypt inside his local church. 4 years later, he was looking for ways to grow his small magazine and started selling mail-order records to the students who bought his magazine. The records sold well enough that he built his first record store the next year. After 2 years of selling records, he decided to open his own record label, his own recording studio. He rented the recording studio out to local artists, including one named Mike Oldfield. In that small recording studio, Oldfield created his hit song Tubular Bells. Boy, does that bring back memories to me. I love that. And if you've been to any of my seminars, you know I play some Mike Oldfield music at the beginning of the seminars to create atmosphere. Anyway, Mike Oldfield became one of the record label's first releases. And that particular song, Tubular Bells, went on to sell over 5 million copies. Over the next decade, that young boy grew his record label by adding bands like the Sex Pistols, Culture Club and the Rolling Stones. Along the way, he continued starting companies, including an airline business, then trains, then mobile phones, and on and on. Now, almost 15 years later, there were over 400 companies under his direction, and today, that young boy who dropped out of school and kept starting things despite his inexperience, despite his lack of knowledge, today that young boy is a millionaire. And I guess by now you've recognised it, you've guessed it, his name's Richard Branson. Now, I recently read a story of how he started Virgin Airlines, and this tale seems to encapture his entire approach to business and life. Anyway, the Virgin went something like this. He said he was in his late 20s and he had a bit of a business, but nobody knew who he was at the time, and he was headed to the Virgin Islands because he had a pretty girl waiting there for him, so he was determined to get there on time. But at the airport, the final flight to the Virgin Islands had been cancelled because of maintenance or something. It was the last flight out for that night. So Richard Branson thought, this is ridiculous, and he went and chartered a private aeroplane to take himself to the Virgin Islands. But he didn't have any money to do so, so he picked up a small blackboard and wrote something like, I don't know, Virgin Airlines $29 on it, and went over to the group of people who'd just been on that flight that was cancelled, and he sold tickets for the rest of the seats on the plane and used their money to pay for the chartered plane, and they all went to the Virgin Islands that night. Now, amazing story, isn't it? Of course, Richard Branson's an extreme example, but we could all learn something from his approach. I guess one way of summarising the habits of successful people could be successful people start before they feel ready. If there was ever anyone who embodied this idea of starting before they felt ready, it really is obviously Richard Branson. The very name of his business group, Empire, Virgin, apparently he chose it because Branson and his partners started out as virgins when it came to business. Branson started so many businesses, so many ventures, charities, expeditions. It's simply not possible for him to have felt prepared, qualified already to start all of them. Couldn't have. In fact, it's unlikely that he was qualified or prepared to start any of them when you think about it. Apparently he's never flown a plane, didn't know anything about engineering of planes, but he started an airline company anyway. He's a perfect example of that saying, the chosen ones choose themselves. So my message to you today, at the beginning of a new decade, a time when you've probably got some good plans for yourself, is if you're working on something important, you'll never feel fully ready. A side effect of doing challenging work is that you're pulled by the excitement and pushed by the confusion at the same time. You're bound to feel uncertain, you're bound to feel unprepared and unqualified. But let me reassure you of this. What you have right now is enough. You can plan, you can delay, you can revise all you want, but trust me, what you have right now is enough to start. It doesn't matter if you're trying to start a business, trying to lose weight, write a book, achieve any number of goals, get going with property investment. Who you are, what you have, and what you know right now is good enough to get started at least. Now, we all start in the same place. No money, no resources, no contacts, no experience. The difference is some people, the winners, choose to start anyway. No matter where you are in the world and regardless of what you're working on, it's the start of a new year. Well, we're a little bit into it. It's the start of a new decade. I hope you're going to start before you feel ready. Well, hopefully you've got a bit more clarity about the correct ownership structures to use. And of course, you can always have a chat with Ken Race. Just go to metropole.com.au, find out about what Metropole Wealth Advisory does. And while he helps high net worth clients, he'll also help ordinary mum and dad investors. Now you've got access to that sort of information as well. By the way, if you've got some benefit from the show, why not tell others about it? Either send them a message, use the share button on the podcast app, or tell the world through Apple Podcasts or wherever you listen to this show. And if I read out your review, as I'm going to read out a couple now, email me, michael@metropole.com.au, and I'd like to say thank you by gifting you one of my books. Now, Beck Misha left a review. Beck said, thank you for this resource. It's been very helpful in learning about property investing from a strategic perspective. Well, Beck, I hope you got some strategic advice from Ken and me today. And there was another review left by Vamshi786 saying, I've been listening to this podcast for 8 months. I can definitely see an increase in my wealth and peace of mind related to wealth. The practical approach to investing is an added bonus. I think the most important takeaways from each podcast is the mindset message Michael talks about in the end, which has taught me about attracting wealth through a positive mindset. Thank you for sharing these precious thoughts. Well, thank you for your nice review, Vamshi. I'll be back again twice a week with the Michael Yardney podcast. In between, You can keep in contact with me on social media. Just look for Michael Yardney. Have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?